Hello and welcome to the DMV Roundtable podcast. I am your host, Jose Barreto, and in today's episode, I am joined here by Ben Taheri from the owner of Mortgage X. How are you, Ben?
Good. How are you, Jose?
Thank you for joining us today. I really appreciate you taking your time to come over here and do this for us and for our audience.
Sure. Thank you for having me.
Awesome. All right, so let's get started. Let's start with a little bit about you. Tell me a little bit about you personally.
So, who am I?
Who are you?
Who am I? So I'm a father of two,
Okay.
a husband,
Okay.
and loan officer to the people.
Loan officer to the
That's what my Facebook bio says.
Oh, okay. I like it.
That's what it says.
Loan officer to the people.
Loan officer to the people.
To everybody.
Yeah. So that's who I am. So I'm an immigrant to U.S. from Iran.
Okay.
And
you're from Iran.
Yeah.
Okay.
Yeah.
All right.
And
How old were you when you came here?
We was 10 years old.
Okay.
We came here with my father and my family. In 1989 there was war and problems. Obviously, problems in Iran doesn't go away, right?
Right.
So we got the hell out of there.
Had to get out. Huh?
Yeah. Oh my God, we walked.
Okay.
We took buses and begged embassies and from Sofia, Bulgaria.
Okay.
Bulgaria, the U.S. Embassy gave us a visa, asylum to come.
Okay.
Yeah.
Gotcha.
So we came and came up here and.
So from Bulgaria, you traveled to the U.S.
Yes, we came to D.C. and
You came here to this area from. Okay.
Yes,
All right.
my father came first.
Okay.
My father first came by himself and then kind of scoped the thing out and then came back and got us.
Okay.
Like about a year later.
A year later. Okay.
Yeah, so it was a sacrifice, right? I mean, my mom was like, "What the hell?"
You've been there a year now. It's time for you to get us.
Yeah, but this was a sacrifice that many families didn't make.
Mm-hmm.
That separation, because somebody has to go to scope things out. You can't just show up with your wife and 3 kids, say, "Okay,
yeah.
where do we go?"
Right.
So he came and then stuff. So we've been here.
How many siblings are you guys?
4.
4. Okay.
4. Yeah,
Okay.
we're 4 of them.
All right.
And so 4 of us came, and then so I came here. I grew up in Montgomery County, Maryland. I went to University of Maryland in College Park. I was a Robert H. Smith School. Business school over there. I graduated in marketing.
Okay.
And that was in 2002.
Okay.
A little bit late, like early 2003. And then from there, I started working as a loan officer.
Right out of college.
Right out of college.
Wow.
Right out of college.
Okay.
Yeah, it wasn't really by choice. I couldn't get another job. I was at that time. Before then, I was interning.
What was your major?
Marketing.
Okay.
Marketing. Yeah,
Okay.
my first major was finance.
Okay.
Then I took finance classes. I was like, hold on, we gotta adjust this here.
There's money here.
That was it. So I was interning at Lockheed Martin in Bethesda, and it was great, and I thought I was going to get a job there and all that, but I didn't get that job offer there for whatever reason.
Okay.
And I was looking for other jobs in the area. I was expecting to come out maybe like $45,000 a year, get my own apartment. I was going to be great.
Right. You had it all planned out.
I had it all planned. I was like $45,000 a year. And I was getting so jealous. These guys with these accounting majors,
Right.
the recruiters would come into the building and just offer them $45,000, $50,000, $60,000 with bonuses. And back in 2003, right out of college, you were like, man, this is the stuff.
Right.
This is what you want, but didn't get it. So I had a professor there, a marketing professor, William Nichols. He wrote the book. I mean, it was his book, 10th edition, because every year you have to pay more.
Okay. Every edition costs you more.
Yeah, I don't know what was wrong with the first edition. He revised it 10 times.
10 times. Wow.
Actually, what I said last year. So
I hope he's not listening.
Oh, poor guy. He used to have a chalk and a blackboard, and he used to call his chalks joints. He's like, "Oh, let me pick up my joint." And he was a hippie from the '60s, like that.
Right.
So anyway, I remember one thing this guy always said. He said, in the middle of the day, around 2, 3 o'clock or 1 o'clock, if you're ever driving around or whatever, you see the guys on the golf course. You see the guys having these nice lunches and hit happy hour and stuff. These are all sales guys.
They're salespeople.
They're salespeople. Yeah,
That's
these
right.
are the salespeople. These are the people that get on. And that always stuck with me, and I was like, that's me. I like to kind of get out there and get with the people.
Right.
So I changed my strategy. I talked with him. He said, listen, you go into sales, you're young, you have nothing to lose, you have no expenses, it's just you. And I didn't have anywhere to live. I was living with my brother, actually right over here in Fair Oak.
Okay.
And I said, fine. So I started looking for sales jobs that paid commission. I looked into this one job where the guy had a business where he would provide janitorial services to commercial buildings.
Okay.
He would get the contract for the whole building for multi-years, and these are really expensive contracts. I don't know, maybe at that time we were talking about like $500,000-$600,000 a year.
Right.
You know. And he had this proposal where he would give me a car and I would go and wine and dine with these people. And when the contract was up, hey, why don't you sign with us?
Right.
I said, how much? Great. How much for a contract? He started talking about hundreds of dollars. Right. I was like, nah, I don't know, man. $100, a couple $100, you could keep your Ford Taurus,
That was not attractive to you.
No, I didn't. Yeah, no, he brought like his hot assistant there, was like trying to show the young college guy something. No, nice guy though.
Right.
But then I met some friends who introduced me to another guy who was starting a mortgage company in his house.
Okay.
And I went to him and
he started the mortgage company from his home.
From his home.
Okay.
Right. So he was
mortgage, like a brokerage.
Like a brokerage.
Like a brokerage. Okay.
Yeah. He was a brokerage, or I think he was a branch of a.
Right.
Bigger company. At that time, this was the hot thing.
Right.
Your net branch.
Right.
So I went and talked with him, and he said, this is what you do. You got to find people who are looking to refinance or buy a house. You could qualify them, and you could make commission on each one. I said, okay, how much?
Right.
And
those numbers. Those numbers.
He was like, a couple $1,000. Okay, this is good. So I got all day every day, and I did the math. I said, okay, I had nothing to do.
Mm-hmm.
So you have all day every day, 8-10 hours a day for 30 days to find 1, 2, 3 customers. I said, sure, sign me up. Right. So I started showing up. He said, first thing you got to do is you just got to look up these realtors, yellow pages. At that time, there was no internet searches.
Right.
you got to find these.
A little different back then.
Yeah,
for sure.
Yeah, there was
a little harder.
Let me just Google realtor in DC area. No, it wasn't like that.
Right.
So you would write down the name and you would cold call all of them and say, hey, this is who I am. We're aggressive. Can I come and meet you and have an appointment to talk? Yeah, no, nobody wanted to talk to me.
They don't know you. They're not going to talk to you with the home purchase.
I was so green, I was so green out of college. The way I was talking even was just so evident that I was just so new.
Right. Right.
Now I understand this after 20 years, how I was talking was just, So, I even had these nice ladies from Long and Foster who were like, oh, God bless your heart thing. I'm like, what? God bless my heart. Are you going to make an appointment or what?
They were not going to.
They appreciated the effort.
They appreciated the effort. Yeah, they were humoring you.
They were.
Okay.
So, and I got stood up a lot. So, it took me 6 months to refinance my mom's neighbor. The guy probably regretted it.
You regret it? No.
That was my first call. I don't know what was happening, to be honest, but it didn't. I don't remember. I remember a difficult situation.
Okay.
And that was that. And then started it, and through a lot of ups and downs. Over the years, I worked at many different companies. I even had my own net branch early on in 2006 and 2007. Me and one of this other loan officer, we teamed up. We paid that flat fee, we split it, and we were like, we're just gonna take all the money, right? So we did that for a few years, and then 2008 and 9 came, where all those things got thrown out the window. There was no more net branches, and then I joined a mid-sized company in Rockville. I was there for 7 or 8 years.
As a loan officer.
As a loan officer, always as a loan officer.
Always as a loan officer. Gotcha.
Yeah, and business wasn't all that for me. I was always like average, to be honest, or sometimes even below average. A lot of times I hated it. I was like, oh, God, this business sucks. And I was so frustrated, because I just wasn't getting.
What was so frustrating about it?
Getting business.
Okay.
And it's
well,
not.
You got that during that time was after the market had crashed, right? So business right after that was a little tough.
It was a little tough to come by. But even before that, leading up to that, 2006, 2007, I had clients. I always had business, just because we were doing a lot of subprime stuff. That was. We were always doing the hard stuff.
Right.
So that was our, But so just didn't have the reach, you know. And in Montgomery County, where I was, in Rockville, Montgomery County, Maryland, it's extremely competitive. It's extremely competitive. There's like
it still is.
It's even more.
Yeah.
It's even more. And there's so many people, and it's like everybody has their own niche. Everybody has their own people that they work with, and it was like you carve out your own niche or you die, or you just hustle all the time. It was hard for me over there to get traction with retained business, you know. And so I was at this mid-sized company. I learned a lot from there. I loved working for a smaller company because of the fact that we got to see all levels of the business, you know, and me kind of thinking I'm inquisitive, I'm curious, and I just want to know. And I think I'm a pretty smart guy. I kind of understood what was going on, you know.
Right.
And then after that, I worked for Capital One. I've always wanted to work at a large bank,
right,
to see what is going on. And, you know, when you're on the other side of the smaller broker side, you're looking at these bank loan officers. You're like, man, these guys must be doing great. You know,
right. So what is it that they're doing?
Yeah, what are you doing over there? You know, so I went there. I went to Capital One. Man, they paid me handsomely, Jose. They paid me signing bonus. I mean, handsomely. Benefits, healthcare, retirement, match your 401k, match your IRA.
Now this is with the same role, the loan officer.
Mortgage loan officer.
Mortgage loan officer.
Mortgage loan officer.
Okay.
Yeah, mortgage loan officer. I was there. I was responsible for not only generating my own business through my own sources, but I had some branches where I would maybe go and they will
pass you the walk-ins.
That will pass you the walk-ins, and you will go there and train up the staff to push the business.
Right.
Or leave material, you know.
Okay.
So you just took care of some branches.
Right.
It was okay. The business there was okay. Obviously, they paid me a ton of money, but their metric system and their value system was so messed up, man. I mean, like we would have sales meetings, and the manager would say, "Oh, how many applications have you taken?" Right. Where I come from, it's like, okay, well, what have you closed?
Right.
What do you have in the underwriting?
It's not about applications; it's about actual closing.
That's right. Yeah. And exactly. And these sales meetings were just always about, you know, like the number one guy there been there for 12 years, and he was like crushing. Like between him, number one and number two was a big distance. You know, it's like the defense budget of the U.S. You know, it's like number one, and then the next four is like the one guy. You know?
Right. So he was doing way more than everybody else.
He was doing way more, but he's been there for a long time, and for a while he was pretty much the only loan officer for Capital One in the D.C. area. So he had a lot of connections within the bank.
Okay.
Right. You would have that's all.
Being there that long, you make friendships, connections
within the bank.
Yeah,
then the bank has a lot of these other sales guys on the business loans, business banking, blah blah blah. There's a lot of big boys in the, and then so they just followed him to business.
Yeah.
So
they trusted him. They knew him for years. So
and they worked at the same company.
Right.
Obviously.
Right.
So he was always crushing it, and I just found these sales meetings. And then later I found out that really in the management of a big company like that, we had 14 managers, I like to call it, but we had 4. You had a district, you had a regional, and you have a national.
Okay.
And all they wanted to do was kiss the butt of the guy up top.
Right.
That's it. That's it. They had their metrics.
Well, they have to make the guy up top look good so that they could be happy, and then in turn they make the bottom people happy.
Right.
I mean, it's a chain.
There's a chain of happiness that needs to happen. I understand.
Chain of happiness, I like that.
I understand that. I get it.
Right.
I get it. But that didn't necessarily mean anything for me.
Right.
At my mortgage loan officer level.
Okay.
You know, when I'm trying to, because like I said, their metrics was how many applications have you taken?
Right.
Not what are we closing?
Right.
And then their processing and underwriting was in Wilmington, Delaware, and it was like, don't talk to them.
So you would send the files to be processed in Delaware?
Yeah, there would be. Yeah,
okay.
They Capital One 360, which is formerly was ING, ING, the orange ING. Capital One bought this ING bank, and ING had a huge mortgage division, and their processing center was in Delaware, and that's where Capital One 360 comes from. This online savings is an old ING thing, and they just took over their mortgage processing division in Delaware.
Okay.
So bank experience wasn't fluid, you know. I
So
mean,
what did you not like? Because it sounds like you were getting good money or earning a good living at Capital One. You have benefits.
yeah.
So what was it that made you leave?
The
Capital One?
performance, the performance. You know, Jose, when I come to you and I say, man, let's do business, and then you trust me with your client. As a loan officer, I can only communicate to you what I've been told by management.
Right.
And then I make that commitment to you because that's what they told me, right?
Right.
But then I take that file from you and I send it in, and then something starts to go weird on the file. You know, it's just not moving, or they're picking at something that's really irrelevant for them to be picking at. And then you come back and you say, hey man, you know, what's wrong with this file? You find out that maybe there's some things they're not so used to as a bank, where a broker is more used to, without getting much into it.
Right.
You know,
That's right.
a bank, you know, they just don't see everything.
Okay.
You know, and they're used to a certain style of clientele, and so, you know, some things they just didn't like.
Okay.
They didn't want to move on. They were unsure. I don't know, maybe they weren't savvy enough. I don't know what it was, but they wouldn't move forward on some style of transactions, which were well qualified. You know,
Right.
these are well qualified people that I closed today, many of them.
Okay.
But they just didn't like this
They
kind of stuff.
couldn't get him close.
Yeah, and later on I found out that any bank, even Capital One, Bank of America, Wells Fargo, you know, they get so many applications in, thousands of application in. They're going to take the best of the best, the ones that they're going to close.
Right.
It's a business, you know, it's
Right.
efficiency, right?
Right.
The manager is sitting there processing. If I was a processing manager, I'd say the same thing too. I'd say, hey man, here's 2,000 application. Let's close the best ones.
Yeah. Yeah. Take the top 1,000 and close those.
Yeah, you're making the same money
Right.
on all of them, so what's the difference?
Right.
Right. So I understood that, but so that wasn't my cup of tea, because when my word is very important. You know, my word, my promise, how I go about saying or providing. So I have to be able to deliver on that, and I didn't feel like the bank or Capital One was a place. And then, you know, Capital One shut down their mortgage division about a year after I left, or 2 years after I left. So
Oh, is that right?
they're not even in the mortgage business anymore, unless that one guy's still there. I'm not going to name him, but he's probably still there killing it. Yeah.
he's their only loan officer now.
Yes, because they did this before. They shut down the mortgage division before, but they kept him. You know.
Okay. All right. So then, when was this? The year that you left?
So, I left in 2000 and late 14.
Late 14.
November of 14.
Okay. And what did you do then?
Mortgage X home loans.
All right. So let's segue. That's a perfect segue
2015.
to Mortgage X. So tell me about your company. Tell me about Mortgage X.
All right. So Mortgage X was two things. I realized that a smaller business, a smaller mortgage lender was the better one, because I was never going to go into this high volume business. I just knew I wasn't going to go into this business where I was going to expect to have this big business. I don't like the risk of high overhead and fixed overhead. I don't like it. I just don't like it. I got 2 little kids, you know. I got stuff. I'd rather live free, you know. So I don't like it. So I always knew we were going to be small, and I found out that, you know, that being small is what allows you to kind of case by case do business. You know, do loans that may be more difficult for a larger lender to do, because you really got to spend more time to figure out the deal.
Right.
You got to have to spend more time to pre-qualify the deal. I mean, you just got to put more effort into it.
Okay.
And for me, that was enough. We don't need to be billionaires or millionaires. We just need to make a living and get through this life, you know, one time.
Right. And do right by your client.
And do right by your client.
Which is paramount. To our way of doing business.
That's right. Your name is everything.
It's the people that we represent, the people that we help. It's everything.
It's everything. These people. And when I say something, and that was the biggest problem I've ever had any place I've ever been. When I say something to you, when I communicate something to you, it's very, very important for me for those words to become true.
Sure.
At 10% tolerance. 10% tolerance based on RESPA. So
10% tolerance.
So those words need to be true. But I couldn't guarantee that if I didn't have proper control over the process and over the system.
Okay.
The bank, forget about it. And then any other mid-sized guy, you always have, you know, the owner or this other guy, and they're going to do things their own way. So I thought I could do things my own way.
Okay.
And so we started this so I could deliver on my promises, so I could actually have some commitment when I tell you something that it's going to come true, and we're going to close it. So that's how Mortgage X got started. It was for control.
Okay.
Control and delivery.
Okay.
Definitely not because of money. Because a high-producing loan officer a lot of the times can make more money than the company.
Okay.
Even, you know, like I have some loan officers who make more money than me.
Right.
Truth.
And that's fine.
And that's fine.
Yeah, that's fine.
That's fine. God bless them. You know, it's their effort. It's their work. So we started that in December of 2015. We closed our first loan. It was just me. I was just me. I had a little executive.
Did you start it from your home?
I leased an executive office.
Okay. All right. Okay.
For like $1 million a square feet. You know. I had a very small office for like $1,400 a month in Rockville, on right by the cinema down there in Rockville Town Center, and it was me in the office working, processing, submitting, post closing, everything. I was doing it, but that's the way I needed to do it if I was going to get my fingers around stuff.
Right.
I can learn by watching and reading, but I really learn by doing.
Okay.
Right.
Good.
So it was me, and then my first loan officer was Katie Posas.
Okay.
Posas.
Oh, Katie
And
Posas.
she joined me only after that. We were friends, and then
which I still haven't met, by the way. And you got to bring her and introduce her to Cam, Jenny, and everybody else here.
Well, hopefully because of the COVID restrictions, she won't be traveling so much anymore. Katie, if you're hearing this, stay at home.
Stay at home. We'll do a
home.
Zoom intro to the rest of the team here so that they
Sure.
get to know her.
Katie, and then from there we expanded. And a lot of the people who work with us are truly friends.
Okay.
First and foremost, they're friends, they're old colleagues, they're other guys who are like me, my age, and they didn't want to work for a bank or these mid-sized lenders with, this boss who's just, he's more worried about fishing than he is about the business.
Right.
And God bless him, the guy, he did his work, but
right.
We're not there. We're driving.
Okay.
We're driving, we're moving forward, we're innovating, we're the future.
Okay.
20 years from today, I'm going to be 59 years old. I'll be here.
You'll be here.
Yeah.
You think you'll be here?
I'll be here.
Okay.
Yeah.
All right.
I'll definitely be here.
And you guys are where now? Where's your office now?
We're in Reston, Virginia now.
Reston, Virginia.
Yeah. About 4 years ago, we moved to Reston, Virginia.
Okay.
Because I wanted to move to Virginia. I wanted to bring my family here. I thought it was a better place to raise my family, and I completely moved offices. It was a leap of faith. It was freaking scary. You've been somewhere for back in at that time it was like 16, 17 years. Yeah. And then you're like, hey, we're going to switch up everything. And I tell you, Jose, is the best thing I've ever did.
Okay.
Best thing I ever did.
You're happy in Northern Virginia?
Yes, much so.
Where do you live? I mean, I know your office is Reston, but where do you personally live?
I live in Ashburn.
Ashburn, okay.
I live in Ashburn, Virginia. That's where I moved to raise my family, my babies. I have a 4 and 5 year old, and that's where
Great
I moved.
area.
That's it.
Great area.
That's it. Yeah, that's it. And I told my friends, I said, when I moved to Loudoun County, it reminded me of Montgomery County back in the 1990s.
Okay.
It wasn't like it is today. It was kind of like Loudoun. It was coming up, not so densely built up. I remember we used to go cow tipping back then. I don't know if you know what cow tipping is.
I know what it is. I've never done it.
We would try. We never actually, nobody had the guts.
Right. Okay. All right.
But we were like, oh, let's go cow tipping.
You never successfully did one?
No, we never did. No, nobody wanted to touch that thing. Anyone was scared to speak up.
Okay.
So we would try, but that's what we did. Back in Montgomery County, that's where we were. And so that's where I came to Ashburn, Virginia to raise my family and work in Reston, Virginia. And I found a lot of success here because I feel there's much less competition here.
Okay.
All
right.
Not that I don't, that's a thing, but it allows me to shine.
Okay.
All right. To do what I do.
Well, if it works for you. I mean, I know Northern Virginia is a great area. I've been in Northern Virginia since '89, and I like it here. So, yeah, it's definitely a great area to live in.
It truly was.
Sure.
I was a hater before. My brother moved.
You were one of those, huh?
I was, but I changed.
Northern Virginia softened you up a little bit.
Yeah, before my brother moved to Fairfax a while ago, and he was, this place is. We were like, and all the other siblings were in Montgomery County. We were like, no, man, this place is. So I came. I was like, no, this is. But I went to Loudon. I said, no, this is better than both of yours.
That's awesome.
This is better than both of yours. All you guys need to come up here.
That's awesome. All right, so now let's go ahead and move on to mortgage programs. I want people to understand what the programs that are out there and what's available to them. Let's start with FHA. What do people need to know about FHA?
Good one. That's a tough one.
Yeah.
FHA has changed night and day because of COVID. Before COVID, I mean, we had investors where we were doing FHA down to 580 credit, maybe even lower, with a good explanation of why some bad financial events happened.
580 credit score, 3.5% down payment.
Yes, 580, 3.5% down, up to 55% debt to income ratios. That's all out the window. The lenders have overlays right now. I mean, the minimum FHA credit score you're doing is 600, 620, and that's with reserves.
Okay.
And that's with low DTI ratio.
Okay.
640 is what they want.
What kind of reserves are they looking for?
6 months.
6 months reserve.
6 months reserve, yeah.
Okay.
So if you're above 50% DTI with like a 600 or 620 FICO, it's 6 months reserve.
Okay.
Yeah, if below 50% DTI.
DTI is debt to income ratio.
Debt to income ratio,
Mm-hmm.
yeah.
Okay.
So, and even at 640, 650, the rates are terrible. You know, even if you have a 640, 650 FHA, 3.5% down, I mean, I don't want to quote any rates, but they're not good. They're not in your twos like your well-qualified person is. Yeah, FHA is no good. And FHA, the structure of FHA has its purpose. You know, for example, FHA for bankruptcy seasoning is 2 years.
Okay.
So it's 2 years.
So that means you can get an FHA loan 2 years after you file bankruptcy. You've been discharged from a bankruptcy.
Correct.
Okay.
Yeah. So this is a huge advantage. Conventional financing is 4 years, I believe.
Okay.
For seasoning requirement on the chapter 7 or 11 or whatever. So there's some things like that. There's also FHA will accept other styles of income where conventional loans won't, such as board income. You know, if you have a roommate and you're getting rent from this roommate and this roommate's going to move to the new house, they can take that money. With FHA, you could also have unoccupied co-borrowers.
Co-borrower, okay.
As many as you want.
As many as you want in FHA, yeah. So that's
you could buy the house and get 4 of your cousins to sign with you.
okay.
You know,
wow.
As many as
to
you
get
want.
you qualified.
Yeah,
okay.
to get you qualified to get you in the house.
Okay.
FHA in general, and then the mortgage insurance for FHA on a monthly basis is important for people to know is it's forever.
Okay.
It doesn't go away.
It doesn't go away after you've had, even if your property gets to that 80%,
loan to value.
Loan to value, you still have to
You pay it forever.
The only way to get out of it is to refinance out of that.
You got it. Yeah, you got it. Yeah, you got to refinance out of it. And then with FHA, you also pay upfront mortgage insurance.
Okay.
1.75% of your loan amount financed into the loan, of which you pay interest.
So you're paying. So you get 1.75 of the loan amount, and then that gets financed over time, and you're paying interest on that 1.75.
Imagine, you're right.
Yeah.
And from day one.
I mean, it has its purpose. I mean, it's just not the most ideal of loan programs.
No. And I think a lot of people don't understand the downsides of FHA.
Okay.
You know, they feel like, okay, maybe I have a 600, 610 FICO. I got approved for FHA. Some people misrepresent FHA as a first-time homebuyer program. That's not true. You know, some people come, I want that first-time homebuyer program, 3.5% down FHA. They think because of 3.5% down is a first-time homebuyer. No, conventional.
There's a lot of confusion about first-time homebuyer programs.
Yeah,
and
I'm confused about it too.
Okay, we'll touch a little bit more about that. But they actually, you're absolutely right. People think FHA first-time homebuyer program. They kind of put those two together, and it's not true, right?
It's not true.
Yeah.
It's not true. It could be your second house. You're allowed only one FHA loan.
Right.
In certain situations, you could have two FHA loans depending on the distance between the two of them. I had a guy who had a FHA loan in New York, and then he got an FHA loan in Woodbridge.
Okay.
They have to have 25% equity on that one, but it can be done. for 2 FHA
But
loans.
for the most part, no.
No, for the most
you're
part,
only allowed one.
yes. So conventional loan allows 3% down payment. You
Okay.
know, so and that is really a first-time homebuyer program. So that's 3% down. But FHA has this mortgage insurance, has the 1.75. So if you could imagine a $400,000 loan, 1.75 is pretty close to about $7,000.
Right.
It's like $6,500
That you're going to pay interest on over time.
rolled into the loan.
Roll into the loan. Yep.
When you come to refinance in a few years or even sell the house,
You have to pay that off. That has to be paid.
yes, sir. It's going to be part of your payoff, and then you're like, So yeah, and another thing is, when you say a 3.5% down payment on an FHA purchase price, and at that 3.5, 1.75 of the mortgage insurance gets rolled into it, you really only have a 1.5 of down payment, 1.5% down payment on the thing, because your 3.5% gets eaten up by that upfront mortgage insurance, that 1.75.
Right.
So maybe actually it was at 2%. You got 2% equity in the property based on the purchase price on day one.
Right.
Yeah.
Yeah.
And then you end up paying hundreds of dollars in mortgage insurance forever. So my point is this: I would like to see people improve their credit and not go
Before
for
they
it.
buy.
Yes.
Yeah. So just work on your credit before you buy. Get into a better program.
Yes.
you know,
Yes.
rather than just jump in and get into this program that's going to
It's
down
very
the line
expensive.
yes,
It's very expensive, right? Because most people that have these kind of FICOs probably have some sort of collection. They got probably some sort of derogatory or whatever. So they're late on stuff.
Right.
Maybe they don't have the means to pay these things off. Well, you know, instead of buying a house, maybe it's a better idea to handle this.
Right.
So this goes away, your credit score comes up, and you get a better loan, right? Because if you're struggling right now with your payment, what's going to happen when you buy a house?
Right.
You know, when you buy a house, you know, I talk about this all the time. You're responsible for everything in the house. Anything breaks, AC breaks, $4,000.
Mm-hmm.
Kitchen, roof, bang, bam, bam, 4, 5, 6. When you're renting, you have zero liability on these things.
That's right.
Something breaks, Mr. Landlord,
Come fix it.
you pay your rent.
Yep.
You know what that is. So based on that, it's easier for you to budget and get your credit to a place and maybe even save down payment.
Right.
Most of the time, the payment goes up when they buy a house. You know, and then you got to buy furniture, paint the house. You know,
Yep.
wife wants a new kitchen.
Yep. Yep.
So, yeah, you got to get ready.
you have to be mentally prepared and financially prepared.
That's right. That's
That's
right.
right.
So that's what I would like to see. I would like to see some people do that. Now, there is some situations where people need FHA, such as where if you have a family of 3 kids and you need to have a house to buy and to put your family in, that's fine. I understand that. You know, you can't live in an apartment with 3 kids or 4 kids, especially
Right.
in this environment of COVID where you're only restricted to your personal property.
Yeah.
You know, so
And I think people are finding that more and more that, you know, you need space, you know, especially because we don't know how long this is going to go. So you need your own space.
That's right. That's
Yeah.
right.
Yeah.
I have a friend of mine in D.C. over in the West End. He has a $1.6 million condo.
Uh-huh.
He says it's worthless.
Yeah, it's so
Completely-
little,
It's
tiny.
worthless.
Yeah.
You can't even go outside. The parks are closed. Anywhere to go anywhere is packed.
Yep.
So,
Okay.
yeah. So that's with the FHA stuff. Good stuff. It works. It helps people, but it's very expensive.
Okay.
All right.
All right.
So you
Very
pay a
good.
price. You
Okay,
pay a price.
so that's
for it.
FHA. All right, so let's go ahead and move on to VA. VA big in this area. I mean, we're
Yeah.
in the DMV area, military, you know, and so VA here is huge. So talk a little bit about
Yes,
about
yes. Yeah, we have plenty of VA qualified borrowers, veterans administration, right? That's what
Mhm.
VA stands
Yep,
for.
that's correct.
Veterans administration. Basically, veterans who qualify, they have what's called a certificate of eligibility.
VA.
And this certificate of eligibility tells them how much qualification they have to buy a house. Usually, I've never had a problem with it.
Okay.
It's always fine. And they could buy a house with 100% financing. 0 down, 100% financing. They're protected, just like with FHA.
There's a funding fee though.
Let's not.
Okay,
We're gonna
we'll
get there.
get there. Okay, all right,
yeah.
we'll get there. All right,
I've
sorry.
crushed FHA.
Yeah, yeah.
I didn't want. I didn't want to crush this.
Well,
thing.
you're gonna have some people after you. After
Yeah,
this show.
like this guy.
Capital
This guy.
One, FHA.
Hey.
Now you're about to mess with VA. All right, let's
You
go.
gotta speak up. You know.
Yeah, absolutely.
So, so the VA, just like with FHA, has certain protections. As you know, as a realtor, Jose, when you do a FHA addendum or if you do a VA addendum, when that seller signs that thing, they're giving some protection to the buyer.
That's right.
Right. So,
That's right.
so these are the great things about them, actually, that I should mention about FHA and VA. The buyer does get extra protection, especially the veteran.
Right.
It's just what it is. But with the VA, 0% down. You get very nice underwriting terms. They not only look at your DTI income, they also look at what's called a residual income. They look at your family size, how many kids you have. There's a form, it's called a residual income form that we fill out for all veterans. And it really tries to take care of a veteran. They really, really do. They limit fees. They limit fees on processing fees, or they limit fees on underwriting fees. I think they even might limit title fees. So there's limitation on
the cost to borrow for that veteran.
Correct.
Yes. That's right.
Yeah. Yeah. So they protect the guy or lady. Now, the bad part. Okay, the bad part. First time user. Okay, so there is a funding fee.
Mm-hmm.
The funding fee can be waived if you have a disability through the VA.
Okay.
Right? So on your certificate of eligibility, there's some coding on the top. And if this coding reads that you have a disability, that funding fee is waived.
Okay.
But if you don't, funding fee, first time user, I want to say 3.3% of the loan amount.
Of the loan amount. Wow.
3.3% of the loan amount.
That's huge. That's a lot of money.
$500,000 loan?
Yep.
That's like 17 grand.
Yep.
Goes through the VA.
And that's supposed to work as sort of an insurance, right? Because they're giving you 100% of
That's correct.
of the value. So this funding fee works as an insurance, and it is embedded in the loan. So you're actually paying interest on that too, right?
Oh, that money, yeah. You're paying interest on that, and that money directly goes to the VA immediately.
Right, immediately.
Immediately.
Yep.
Same thing with the FHA mortgage insurance premium.
Right.
It goes in there, and
it goes into that bucket. It's supposed to be an insurance.
That's correct.
Yeah.
For default.
For default. That's right.
Risk against default.
Mm-hmm.
So yeah, I mean, same thing with FHA or VA. Lending business is a private business.
Mm-hmm.
You know, there's executives who are making decisions of what are the guidelines, whether it's Fannie Mae, Freddie Mac, or whoever, or VA, or even the banks themselves. A bank is never going to give you 100% financing.
Right.
Just doesn't make sense.
Right. That doesn't make sense. Yeah.
A bank is never going to give 97% financing to somebody with a 620 FICO.
Right.
It's not.
Right.
It just doesn't make good business sense.
Right. They're putting themselves at risk if they were to do something like that.
Correct.
I mean, obviously.
FHA was
They have to manage the risk. I mean, they're not doing this to be mean. It's just that they have to manage the risk. I mean, if you foreclose, they have to have something that protects them, so that
correct.
when they can sell the house, they can recoup their money.
That's correct.
Yeah.
Risk management.
Risk management.
Risk management.
Correct.
And it's a private business. They can do as they please.
Of course.
Okay. So this FHA and VA...
funding fee.
Oh,
Yeah, we were talking about the funding fee, how it acts as an insurance.
Okay, the insurance
Sure.
part.
Yeah.
Right. Okay, the insurance part. Right. So when banks lend this money, they lend it based on the protection of FHA and VA. Now, FHA was created, I want to say, post Great Depression, right around the Great Depression time.
Mm-hmm.
I think Roosevelt may have done it, where he was like, okay, people are like living.
It's been around a while.
Yeah, people were living like in like shacks.
Mm-hmm.
They were like, we can't have shacks in the United States.
It was to help home ownership.
Yeah, because they were like, we can't have shacks in the United States.
Right.
It's embarrassing.
Right.
So let's give them houses.
Right. With the VA, I mean, the rates are also good, right? With
The
VA.
rates are also excellent.
So
They're the best.
Okay.
So 30-year VA rate, I mean, I just closed one for a buddy, 2.3%.
Wow.
30-year fix.
Jeez.
2.3, 2.2, 2. Yeah.
That's insane.
4, yeah. Excellent rates. But you pay.
You pay, yeah.
You pay that funding fee.
Right.
You pay that fund, and then subsequent use. When you come and refinance your VA, you also pay again, just like with FHA, you pay again. One advantage of these two, I should mention, is when the market rate gets better. If you have an FHA or a VA loan, you could come back and very easily refinance. There is no income requirement. There is no appraisal requirement. there's not even in some cases not even a credit check. They just want to make sure you're making your mortgage payment on time.
So as long as you have a good standing with them in terms of making your payments on time, they're basically going to refinance you.
They'll refinance you, give you
And
the
that's
new rate.
what they call a rate on term, right? You're not going to take cash out. For a cash out,
No, right.
they have to look at everything. But for rate on term, in order to lower your rate, then it's easier.
That's correct. Yeah, the FHA one is called a FHA Streamline Refinance.
Mm-hmm.
No income, no appraisal, no credit score in some cases. And then for the VA, it's called a VA IRL, and it's called a VA interest rate reduction loan.
Okay.
No income.
So if
no appraisal.
people out there who are listening right now or watching, if you have a V8 or an FHA loan that you got a while back and your rates are above what they are today, just take advantage of that and go ahead and refinance as soon as possible and get that payment lower. Because you'll get a lower payment for sure.
Absolutely, and that's the perk in paying that.
Because you're not really increasing the loan amount, you're just lowering the rate, so your payment is going to go down.
Your payment will go down. The increasing the loan amount will.
It'll be minimal. You're not taking money out, right?
You're not taking money out.
This is rate and term.
Yeah, you probably roll in your cost.
Your cost, right? It's just your cost that'll increase, but with the rate,
your payment will definitely
drop.
It always makes sense,
right?
I mean, if I tell you save $300 and put $3K in your loan, you're like, sure, no problem.
Yeah.
Yeah.
Why not?
Yeah. So those are some of the advantages of the FHA and VA, and both of them are grouped together. They're called government loans.
Government loans, yep.
That's where they go. FHA, VA is always on the same thing. It says FHA/VA.
Okay.
And they're called the government loans. Come and get screwed.
You're gonna get a call from somebody after this show.
Come and get screwed, loans.
Just let me know if you don't want me to publish it. It's up to you. I can always just not put it out there. But anyway,
be kind to me.
So let's go ahead and move on to the conventional.
Beautiful.
Loan. Okay.
This is the loan. This is the one. This is where everybody needs to be.
Why?
This is the good stuff. All right. So conventional loan typically is your best rate and cheapest loan. You're not going to have any mortgage insurance with this stuff. You don't have any funding fee. You don't have any extra fees that have to do with the transaction.
Okay.
If you're buying $100,000, you're putting down 20% or $20,000. You're borrowing $80,000, not $1 more.
Right.
You're borrowing $80,000. For conventional loans, there is different levels you could be at. You could be at 3% down payment,
okay,
which is for first-time home buyers. In some cases, subsequent buyers, but it has to be a make-sense situation. But
for the most part, this is a first-time home buyers program,
the most part, yeah,
where they allow you to come up with 3% down.
Conventional loan.
Conventional loan.
Yeah. So 97% financing.
This is the lowest down payment there is right now.
This is the lowest down payment you have.
Yeah. Okay.
Yeah.
Even lower than FHA.
Even lower than FHA.
Right.
Yeah. 3% down. You gotta have the credit score.
Right.
You got to be like 690, 700, and above. And your debt to income ratio has to be below 45%. So you got to manage your situation. You got to manage your finances.
So you have to have your finances in order and your credit in order to take advantage of this conventional.
That's right.
Style loan.
That's right.
Okay.
So 3% down, and then you will have monthly mortgage insurance. Anything above 80% financing.
Yep.
Anything above 80% financing, you have monthly mortgage insurance. Now, there's something I want to say about monthly mortgage insurance or mortgage insurance in general. Mortgage insurance is delivered in many different forms. But it exists.
Right.
Okay, it exists. Above 80%, 85, 90, 95%. It's there. But there's many different ways a lender can charge you mortgage insurance. One is monthly, which is the most common.
Right.
Another one is called a lender paid MI, or is built into the interest rate.
The interest rate, yep.
So we give you a little bit higher rate, and we say...
And waive the
monthly... Mortgage insurance. But they get it.
They get it, yeah.
We just take the higher rate.
You're basically paying for a monthly in a different way.
In a different way. Yeah, in a different way. And sometimes that makes sense.
That makes sense sometimes because you're paying it over 30 years rather than paying it.
And your payment will be lower.
Your payment will be lower, right?
Your payment will be lower, right? Because that monthly mortgage insurance is on an amortization schedule for it to go away at 80%.
At 80%.
Automatically. You don't have to lift a finger.
Right.
If you feel your property has appreciated, you could always call in and say, I feel like I have 20% equity in my property. And your mortgage servicer will appraise the property or do some sort of internal valuation to find out if you're at 80% loan to value ahead of your amortization schedule.
Right.
and then they'll get rid of it.
And they'll get rid of it. Okay.
They'll get rid of it. So you could call in, or you could pay a lump sum.
Right.
Right,
And pay for it up front and say, I don't want to pay it anymore. Here you go.
That's correct. You've been in the mortgage for 2 years. I don't know, you get 50 grand from somewhere, and then you take that 50 grand and you reduce your principal balance to your 80%.
And done.
Done.
You're done.
Done. Yeah. So that's the beauty about conventional loan, right? These are the things. Now, the optimal financing is 20% down.
Right.
Okay. You put down 20%, day one, you don't have mortgage insurance.
Right. You have no mortgage insurance. Your rate is going to be the lowest possible.
That's right.
That's out there.
That's right.
Because you'll have good credit, 20% down.
Good DTI.
Good DTI.
That's right. Yeah. And the qualifying factors, they're basically your credit, your income, and your down payment. And they're all equally important. There isn't one above the other.
Right.
There isn't. You can't have good income and no down payment.
Right.
You can't have good credit and no income. It just doesn't work.
Right. It doesn't work.
They're all equally important.
Right.
So, that's what it is.
Okay.
Yeah.
So conventional is the
That's the
loan
one
to have.
That's the one. Yeah, that's the one where it's going to get you the cheapest transaction cost, right? Because when we do transaction, we'll take the loan. I mean, that's your money. You're buying the $400,000, $500,000, $600,000 house. Fine. You sign the contract for the purchase price. Here's your down payment. I'll take the loan. But you want to minimize the transaction cost.
You want to, okay.
Yeah.
Okay.
Something else I want to say, I forgot.
That's okay. That's all right. So now let's clarify something. What's a conforming loan?
A conforming loan is basically a term from Fannie Mae and Freddie Mac. And it basically, I don't know. I mean, you could ask different ways, but the way I understand it, it basically conforms to their standards.
Mm-hmm.
And it has 2 tiers. You have a first tier up to about $510,000 and $400 in these counties around here. I mean, and
in our area.
In our area, yeah. In the DC area, most of not all, but most of the counties that are like attached to DC.
Yeah.
Yeah, you go 2 counties over, it's a different story.
Right, it's a different story.
Yeah, so that's your $510,000, and that's where you get your 3% down.
Okay.
That's called tier 1. Counties that have more expensive homes also have a second tier. The second tier of conforming loan, or some people call it super conforming loan, or we also call it high balance loan. Right. Different terminologies. Goes up to
714. No.
They increase it all the time. They just can't keep up with the prices going up.
It used to be 714.
Yeah, it's higher. I want to say, Jose, 750, 760.
Oh, wow. Okay.
Yeah.
Okay.
I want to say 760. So that second tier loan in Fairfax County and Loudoun County and Montgomery County has increased. I think they just increased it this past year, and they're always increasing it.
Right.
Because it's just houses are getting more expensive.
Right.
So these loans.
Yeah, the 510 you were talking about was 417 at one point.
Yes,
right?
sir.
It wasn't back in the day. It used to be 417. Now it's up to 510. Now you're saying the second tier is 760, and then beyond that becomes jumbo.
That's correct. Jumbo. That's correct. Okay. That's correct. That's correct.
All right. So why are these tiers different? Because the interest rates are different, right? They get affected. Go ahead.
Yeah. So many things are different within these different tiers of loans. So first of all, Fannie Mae and Freddie Mac create guidelines for this. So the first tier of loan, which is up to like 510, we call it regular conforming loan, has its own set of guidelines and rules. And then you have your second tier, which is your super conforming or high balance, has its own rules. Meaning, for example, one easy one is 5% down payment.
Okay.
There's no 3% down payment at that loan level.
At the
high balance.
High balance.
Yeah, or super conforming. Jumbo, jumbo is a different story.
Yeah.
That's a whole nother deal. So that second tier loan is 5% down, and it's stricter underwriting, right? I mean, it's more money. There's more at stake here. So there's a little bit. They look at things a little bit differently. So underwriting guidelines are different between first, second loan. Now, jumbo loans is a whole different animal. Jumbo loans. These first loans, we follow guidelines of Fannie Mae and Freddie Mac. For example, if an underwriter comes in and tells me, if I hand in a file and an underwriter comes back and says, Ben, you miscalculated the income, and I review it the way she calculated it, and I review the Fannie Mae or Freddie Mac guideline, I could go back to that underwriter and say, no, Mr. Underwriter, this guideline here, this Fannie Mae and Freddie Mac guideline, says that I could calculate it like this, and this number, for example, should be included, and they have to accept it.
Right, because you showed them where, yeah, okay.
Because the law was written.
It's straightforward.
It's written, and I have to be an expert of knowing the law, which is what I do and why I'd like to think I'm a little bit successful. My guys that work with me are successful because I always preach, know your guidelines.
Know the guidelines.
Don't ask me, here's where you could get it.
Okay.
What was that thing about the horse at the water?
You can lead a horse to the water, but you can't make him drink.
That's correct.
That's right.
So I was like, go. This is where you go. So that's what it is. Even with FHA and VA too, you could force an underwriter's hand if they're misreading the guideline or they're missing something. You could say,
well, they missed it. They're human. Sometimes they miss stuff. Yeah, it happens.
It happens. But you could correct them.
Yeah.
Jumbo? No. Jumbo loans are. Their underwriting guidelines is whatever that bank or that entity wants it to be.
Right. Okay.
There is no backing by Fannie or Freddie on those.
Okay.
Those are straight private agency loans. Meaning some money fund manager, I don't know where money comes from in this country, to be honest, but there seems to be unlimited amount. I don't know. I have no idea. But there seems to be unlimited amount. Wherever this well of money is,
they're doing.
These guys are the ones that are lending on these jumbo. They could do whatever they want.
Okay.
They could say, I want 10%.
So you can't
5%.
change that.
They could change it in the middle of the deal.
Gotcha.
They could make a decision on the deal based on a business decision on the deal.
Right.
They could even take cross collateral. Like if you have like 3 other properties that are paid off, you say, hey, I'm going to put all 3 properties. You could put a lien on all 3 of my properties, but give me enough money to buy this one property. They'll do that.
They'll do that. Yeah, they'll make those exceptions and rules. Yeah, okay.
They make business decisions like the way we used to make business decisions before Dodd-Frank.
Before Dodd-Frank, that's right. Boy, that's our podcast. Yeah. Dodd-Frank just by itself is a podcast.
Frank Barney, my boy.
Yeah.
So,
right.
Yeah, so that's what it is.
So great. Yeah, that's what I wanted people to understand what conforming was, jumbo and this stuff. So
yeah,
that's good. All right, so now let's move on to 15-year versus 30-year. I wrote that down because I want people to. I know everybody does 30-year, but tell me the benefits of doing a 15-year versus a 30-year.
Money, baby.
Money. It's all about money.
It's all about the money. So first, you could do any year mortgage you want, at least with us. Right. You could do anywhere from 8 years to 30 years. You pick a number.
Okay. 17,
16, 19,
really?
9, 10, 11, 12, 13, 14, whatever you want to do.
Okay.
We could do that. We could amortize it. Whatever you like it to do. But obviously, it's very simple. When you get I don't even care what the interest rate is. Yes, 15-year interest rate is less than the 30-year interest rate because you are securing a loan for less period of time. Right. And then if we go back to risk management and what's the risk equation over 30 years versus 50? Obviously, it's less than 50. Right. Or 10.
Right. Which
so
we have those too.
We have 10 years. Yeah, we have 10-year fixes. So the 15-year versus 30, it's all about the time that it takes you to pay this loan, and over this time, how much interest you pay every month, every day, every year. Simple as that. On a 15-year, or on a 30-year, or compared to a 15, you could literally pay half as much interest. So if you buy, let's say, if you get a $600,000 loan or $500,000 loan, over 30 years, it doesn't matter what the rate is, because it's a very small. By the way, let's talk about something like interest rates.
Okay.
Interest rates is an annual rate.
Right. That's an annual rate. Yep.
So you get charged that rate every year.
Right.
So over 30 years, you could have paid 18% interest.
Right.
19%.
When you add it all up.
When you add it all up.
Yep.
So. 3% rate, 4% rate, you're paying 3-4% every year. It adds up to be a big number over the term. Right. And so it's the time that takes your interest, that takes your money, not the rate, if that makes sense.
Right.
Because over 30 years, let's say you get a $600,000 loan. Over 30 years, you're expected to pay about the same amount in interest, about $500,000 or something, just a little bit shy of the loan amount you'll pay back in interest.
Right.
You spend $1.2 million.
So it's basically double.
Yeah, in 30 years. But you got to borrow money for 30 years.
Right.
right? And you got to get into this house on a low payment. Nobody has 30-year loans. Nobody in the world.
Right.
Doesn't exist.
Right.
Maybe China. I don't know.
Yeah, who knows what they're doing over there?
Yeah, they got a lot of good stuff, I think.
Yeah. Okay.
So 30, and then you got a 15-year loan, right, where you pay the same $500,000, $600,000 thing. You're paying maybe like $200,000 in interest
Over the course of those 15 years.
over the course of 15 years, because on a monthly basis, and like I said, I don't care what the rate is, on a monthly basis, you're contributing so much more to principal than you are in interest. And you reduce your principal by that faster clip, by that faster speed.
Right.
Because the way you pay interest, the way your interest is calculated on a mortgage statement is principal, current principal times the rate divided by 30 days, for example.
Right.
That's billing cycle.
Right.
That 30-day base billing cycle. So let's say it's a $100,000 loan at 2%. That's $2,000, divided, actually in this situation will be divided by 12.
Right.
Or 365 days or whatever. Because, not every month is 30 days.
Right.
So they do break it down per day.
Yeah, they do it per day. Even when you go to the closing, you can see the days of interest that they charge you.
That's
so
right.
That you could get to. Yeah.
That's right. And then when you settle on a loan, you'll see your per day interest that you're going to pay from the day that you settle to the end of the month. Well, when you make your first mortgage payment, it's not the same interest. It goes down a little bit because you made a principal contribution.
That's right.
You reduced your principal. So the next month is instead of 100,000 times 2%, it's 999,999 times 2%.
That's right. Okay.
But your payment stays the same. So what happens there is you pay a little bit more principal and a little bit less interest.
Every time, yeah.
Every month.
Yep.
Every month. So you pay less less interest,
more principal.
more principal every month,
Until it flips at one point halfway through, I think it just
50-50.
50, and then it starts going the other way.
And it starts going the other way.
Right.
Where like towards the end of the loan,
You're paying nothing but principal.
you're paying nothing but principal, and the bank's like, thanks, I already got your money.
Yeah, all right. You're paying the bank first.
You're paying the bank first.
Let's make that clear.
That's
the
right.
first half of that loan, you're paying the interest to the bank.
That's correct.
That's basically what you're doing.
The amortization schedule is made so you pay your interest upfront.
Right.
It's not evenly spread out through 30 years.
Right.
You pay your interest. But that's also because your principal is heavy upfront.
Right.
So when you get towards the end of your amortization, your principal is nothing.
Right.
It should
You
be,
would have paid a lot of it already.
Yes. Imagine if you have like $80,000 left on a $600,000 loan. If you have $80,000, you could still be like 3 years away or 4 years away.
Right.
If you only, if you're making like $2,000 contribution, 80 to make up, it's still a lot of money.
Right.
Still a lot, but you're not paying interest.
Right.
You're paying almost all principal. So it's this time of you keep paying interest every month and your principal just slowly going down versus going down twice as fast on a 15-year. Your principal goes down twice as fast on a 15-year. So this 50% point where you pay 50-50 on a 30-year loan is 15 years.
It's 15, yeah.
On a 15-year loan,
7.5.
7 years, seven and a half years.
Yeah.
You had that 7.5 years. That's like imaginable. I can imagine.
30 years is like, wait, let me do math. I'm gonna be how old?
No, you're gonna forget about it. I'm not gonna even. I can't even think like that.
Awesome. All right, very good. Let's talk closing costs real quick and down payment. So closing costs encompasses what? What are the closing costs for somebody looking to buy a house?
Yeah. So this term I don't like. Okay. Because as you know, there's more than cost when people talk about this figure. Mm-hmm. Right?
Yep, of course.
What's the cost? Oh, it's coming to you. No. So typically closing costs is between 2 to 3%
of the loan amount.
Of your
sales price.
Purchase price.
Okay.
Of the purchase price. 2 to 3%.
So let's say you're buying a $500,000 house, we're looking at $12,500 to $15,000.
That's correct.
Okay.
Yeah.
In closing costs.
In everything.
That doesn't include down payment though. Or does it?
Does not, no.
No, does not. Okay.
No.
Good.
Does not, no. We're talking about just
the
transaction cost.
Transaction cost.
Your down payment is separate. If you're going to put down 3%, that's another 15 grand.
That's another 50 grand.
If you're going to put down hopefully 10%, that's 50 grand.
Right.
Hopefully you put down 20%, 100 grand.
100 grand.
Right? So
Mhm.
that's how you get prepared to buy a house, in
Right.
my humble opinion. I mean, you got these people want to buy $1 million house with 3% down.
That won't work.
Oh man, Navy Federal
Well,
Credit.
they used to do that back in the day. What? Navy Federal Credit?
I got this guy who called, said, "Oh, anyway."
Anyway.
So, okay, so the term closing cost is a big problem because it's actually not a cost that you're paying for the transaction. Within the transaction cost, not your down payment, not how much you're paying off the price.
Right.
Okay, is many things. There are costs that have to do with the transaction. You have lender fees, you have title fees, and then you have government fees.
Okay.
This is all your costs. That's it.
That's it.
Lender fee usually $900 to $1,400. The lender takes to pay who we got to pay to make sure we're not breaking Dodd-Frank.
Okay.
Right? It used to be $600 for lender fees, but they did Dodd-Frank, and we got to have like counsel on board, and we got. I don't know. I mean, are we breaking the rule, dude? Here's $500. Tell me.
Yeah, tell me. Let me know.
Here's some money.
Make sure I'm not.
Right.
Okay.
So business costs has gone up since Dodd-Frank. So that's why we have this $1,000 or $1,500 fee.
Okay.
And it's third party. We don't generally charge anything.
Right.
We don't generally charge anything. Then you have your title fees. The title company has to do their work. They have to go get the title services.
They do a lot of work.
They do a
bunch of work.
And you want to make sure they do their work.
Right.
Because when you sign
it protects the home buyer.
Yes. When you sign
and the seller too. It protects everybody.
It protects the transaction.
Yeah. People don't understand how important a title company is to this process.
Somebody asked me one time, he said, "Who does the title company represent?" I said, "The title company represents the transaction."
The transaction. Yep.
Not you.
Yep.
Not the transaction.
Mm-hmm.
The wholesomeness of the transaction. Now, what does that mean? That means they as much as they know, because it's not perfect, they have searched the title, the deed. They identified the owner as the seller.
Right. Yeah.
Which is really important.
Very important.
This is a funny business, you
know.
Oh
yeah.
They identified.
We had funny business back in the middle of 2000 where. Yeah. Anyway.
Back in my country, this is a big deal. So they identified the deed and the owner.
Right.
And then they identified the liens on the deed.
Yeah.
And who this person owes.
Right.
And most importantly, if the guy is currently under any civil litigation too.
Right.
They search
that may affect the property, the title of the property.
Correct.
Which is clouds. It's things that they call the clouds on title.
Clouds
right?
on title.
Yeah.
Right. So if the guy is in the middle of a $100,000 lawsuit from the builder that put on his extension on the house, I think you want to know.
Mm-hmm.
Right.
Yeah,
So the title company does this search, and then they get it checked by their underwriter. They also have an underwriter.
Right.
Right. They have this title underwriter.
Right.
I don't know. I've never met one.
Right.
I don't know where these people are. Maybe we're same place where that well of money is.
But they need them.
But they need them. Yeah. Seriously, Jose. I've never met these. I don't even know who they are.
Yeah, I've never met them either.
So there's an underwriter who says, okay, this title is good to be transferred.
We're guaranteeing that this title is good.
Correct. Mm-hmm. And they issue the title commitment. They issue the insured closing letter. Mm-hmm. And they issue the title lender's insurance policy.
Right.
And it's really that lender's insurance policy that guarantees me as a lender when I put a $500,000 lien on that house at 97% financing. Right. that there isn't somebody else going to come and say, hey, no, buddy, I had a lien on this house too.
Right.
For $100,000 and now you're bumped out of your equity.
Right. Okay.
So that's what the title company does, and it's very important. And so they charge for this.
Right.
And then the lender's title insurance is mandatory.
Okay.
And then you have your transfer taxes. The state and county tax you on the transfer of the deed. Different numbers. It's always going up. I can tell you that,
Yeah.
But they tax you on this. Why? I don't know, but they tax you on this. They tax you. I don't know. I have no idea. Because you pay the recording fee.
Right.
And you pay a tax.
You pay the recording and a tax. Yeah.
So it gets expensive. So these are the three services that have what you call title cost.
That's the title piece of the closing cost.
Correct.
It's
the
all
title
of those
piece,
things that they do.
The lender fees, the title fees, and your transfer tax. This is the cost of the government fees. Is your cost of transaction.
Right.
Done.
Okay.
Next, what you have is prepaids.
Right.
And this is just going off the CD.
Yeah.
I've seen so many. I'm imagining it in my
CD
mind.
means closing disclosure.
Closing disclosure.
Some of the people we're talking to they don't know our lingo. That's why I'm interrupting you. But go ahead.
Yeah.
Go ahead.
Closing disclosure is the pre-closing document you get and the one you sign at closing.
That's right.
3 days before closing, at least 3 days, you're supposed to get your closing disclosure for you to sign at closing. And then anything before this closing disclosure is called a loan estimate.
Right.
And this closing disclosure means we're locked down. Pretty much, we're done as far as our costs.
Right.
Escrow and prepaids, prorations, different story. And this is what we're going to get, different story. Okay, so that's the cost. When someone says closing cost, I'm thinking these three.
Right.
But there's more. There's your prepaids, there's your escrow reserves, and there's your prorations.
Right.
And these can be any number. These can be astronomical numbers, as I'm sure you'll find out.
Which
from
is
the
why
builder.
the difference between the 2% and 3%.
Correct.
Like it could be 2%, but it could also be up to 3%.
Yeah. Sometimes even more. On a new construction, you're paying 4 to 5%.
Right, because you have the transfers fee and all that good stuff.
When you buy new construction from a builder, the builder doesn't split the transfer tax with you 50-50.
Right.
They say this is yours.
You pay it. Yeah.
Yours. And then you have a lot of these upfront fees and utility fees.
Right.
Capital fees, whatever. So prepaid, what prepaids is, for example, your home insurance policy. You bought a home insurance policy because you need to, because you're getting a loan. And so the premium is $500.
Right.
Okay. You don't pay that before. You pay it. It gets collected into your CD in part of your itemized fees.
Right.
So that's $700 for your home insurance policy. It gets collected all right there for annual premium. Any property taxes that are due within 60 days of this closing.
Right.
Have to pay. For example, right now in November, if you're closing a loan, that December property tax is due for first half of 2021.
2021. Yep.
We're collecting that.
Yeah, you have to collect it.
We have to collect that because it's not going to work. When am I going to collect it from you?
Right.
In 30 days? We can't even get the loan situated in 30 days.
Right.
So we're going to collect that from you.
Right.
This is not cost.
Right.
This is your property tax.
This is your property tax.
And home
insurance.
insurance.
This is not the cost of getting the loan. This is actually yours. It's yours.
If you were to buy the house cash,
you still have to pay that.
You still have to.
Doesn't matter.
Doesn't matter.
Yeah.
I'm not sure. If you go and get this loan with 10 other lenders, these are all constants.
Right.
They'll be the same number.
Right. Insurance, you have to pay for a year up front.
Insurance, you pay for a year up front. And the rest of it gets escrowed in reserve. And that's your second part. You have a reserve escrow. So for them to be able to pay your property tax again in June or July, or to pay your home insurance next year again, they're going to collect a few months in reserve based on this calculation of when the next due up. So 2 months, 3 months of reserve for property tax. Again, not cost.
Right.
Reserve for your future payment. And the last part, you have prorations, which is basically between you and the seller. If the seller has already paid the property tax to the end of 2020, from today to the end of 2020, you take ownership of that property, so you got to pay the guy back.
Yep. And so that gets done. That math gets done at the settlement.
At the settlement. Yep. This is one of the final touches is these prorations. Reason is these final touches because they're date sensitive.
Right.
So no one's going to start working on this until the closing docs are there, and we're ready to close.
Right.
It's just, you can't, people are busy.
Right.
So you have the prorations even with the HOA, things like that. So that basically what encompasses your what you say closing costs, but I would like to say closing costs and prepaids and escrow.
Right.
And prorations.
Right.
Because these are not costs to the transaction.
Right. Okay.
So so like on a $500,000 transaction, let's say 3% is $15,000. You're gonna have about $5-6 of prorations and taxes.
Right.
Being collected. You're gonna have about $5-6 of transfer tax.
Right.
And the rest is going to be your costs.
All the costs that we discussed, the lending fee, the title fees, and all that good stuff.
That's right. So that's what constitutes that. Now, that 2 to 3% works in a funny way. The lower the price is, you're closer to the 3%.
Right. The higher
the price is, you're a little bit less than.
Right.
You're closer to that 2%.
That's right.
Because there's fixed costs.
Right. There's a lot of fixed costs. Yeah.
So
that doesn't fluctuate with the loan
sales
amount
price
or sales price.
Yeah, it doesn't matter. Appraisal's $500. I don't care if your property's $80,000 or $600,000.
Right.
It's $500.
Right.
But as a ratio, $500 on $100,000, it's 0.5% or something.
Right.
But on like a $600,000 loan, it's like less than 0.5%. It's like
Right.
0.1%.
0.1%. Yeah.
So.
Yeah. Okay.
Yeah.
Very good. All right. So if somebody wanted to apply for a mortgage and they're looking to buy a house, what's the process like? What do they need to do to get in touch with you and to get this process going? And also, if they wanted to refinance, we touched on the refinancing of a VA and FHA, how it doesn't really have much cost and how easy it is. You have the streamline. Yeah. So if they wanted to do that, tell us how they get in touch with you. Tell everybody how they can get to Ben.
Sure. Okay, so the best way to get a hold of me generally is through my website.
Okay.
www.mortgagexhl.com.
Say that again.
www.mortgagexhl.com.
Okay.
From there, there's links to request an estimate on a refinance.
Okay.
Or you could request a consultation on a purchase.
Okay.
And there's also a mortgage calculator, but I would recommend requesting an estimate on a refinance,
right?
Or if you want to just consult on a purchase, or you could even request an estimate on a purchase too. We designed a website to be completely different than like your large Quicken loans or something like that. We're very much there's no personal information. We just ask for numbers.
Okay.
When I provide an estimate, I don't need to pull your credit. I just want to know the numbers.
Okay.
Your loan, your value, your credit score, your zip code. We're going to work on good faith.
Okay.
That's just the way it's going to go.
Yeah.
And I'm going to send you an estimate based on the information you put on the website. I'm going to email it to you. You do have to put your email so I can email it to you, right? So I'll email you the estimate, and if you like it, we work.
Right.
If you don't like it, we discuss.
Right.
And that's very much the way it is. There's no two ways about it.
Right.
And my estimates are very accurate.
Okay.
When I give an estimate, I deliver the estimate.
Okay.
It's part of the commitment and what we talked about earlier.
The personal touch.
The control.
The control.
Control, yeah. Right? Because I can't be the owner of the place and tell you, hey, somebody made a mistake.
Yeah. Oops.
Yeah, I forgot to include that fee. But being the owner of the place makes it easy for me to honor my commitment, because even if mistakes are made, I eat it.
Right. Okay.
It's easy for me to eat it.
Wow.
I don't have to ask anybody.
Right. You're the owner.
Yeah, I'm like, oh man.
I like it.
My reputation is better than this $500 I messed up on.
Right. So
I eat it a lot.
Okay. All right. Okay. Well, that's good. That's definitely good to know. But what about agents? If because I know agents listen to this podcast, and agents, if they want to use your services and they want to recommend their clients to you, same thing. Go to the website and contact you through there, or do you want to give them a different way to contact you?
No, they should probably just contact me directly.
Okay. And
anybody can contact me directly. To be honest, my cell phone number is out there. It's out on the internet. I'm highly reviewed on Facebook, on Google, on Zillow, on Yelp, I think. And these are real reviews.
Right.
I don't have like 2,000 reviews.
Good. Good. Like, you're not supposed to, right?
Yeah, I don't even know. Like, I'll go. I'm like, this guy has 2,000 reviews. like how the hell? I know he started before me. Like I just started after.
Must have been way before me.
Yeah, I don't know. No, I have gotten compliments from people, Jose, honestly, that say, you know what, I read your reviews and they seemed real.
Right.
People have said that to me.
Right. Well, the realness of reviews is important. That you getting somebody to actually write you a review and and be honest about that review. I mean, that's one of the things that I tell people about me personally is write me a review, be honest about the process. Even if there are parts of what went on that you didn't like, just put it out there. It's just, a review should be honest, and people should be able to. I'm not the realtor for everybody, right? So you read my reviews, and that's right. And so if you read the reviews and you're like, that's not my type of guy, then that's fine. But if you read them and you go, yeah, that's what I want, then hey, I'll take care of you. So I appreciate you saying that about reviews for sure.
Yes. So they're authentic, and they are from my real customers, and I think they're fair. So anyone that wants to work with me or my company, I have a team. It's not just me now.
Yeah. That's what I was gonna ask, but it's not just you, right?
No, we've gotten past that, very quickly.
Okay.
So we have in our office, we have 3 processors that work with us. We have remote underwriters. We have multiple loan officers that work with our company, and we're a pretty good operation now. I'm still a producer. I like to produce. I like the producing side of things, and I don't find the managing of the business that challenging.
Right. Okay.
To go fishing.
Right. To not do it.
To not do it. Yeah. I mean, if I didn't originate, I'd probably have nothing to do all day.
Right.
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 What am I doing? These guys,
managing these guys. Yeah.
Yeah.
These loan officers who know what they're doing anyway, right?
They know what they're doing, right?
Yeah.
Because we don't play.
Right.
When people come and work with us, I always say to them, my goal is for you to work autonomously.
Right.
And you will get paid handsomely.
Okay.
Good. And I don't hold hands when it comes to professionals because I expect them to be professionals.
Absolutely. Absolutely.
Because I want to do what I want to do, and they have to do what they want to do, and that's what it is. So people can call me directly. My cell phone number is 202-215-8421.
Okay.
And my email is ben, B-E-N, @mortgagexhl.com.
Perfect. Okay. Yeah. Well, I appreciate you coming on to my podcast.
Sure.
It was a ton of fun. I really wanted to do this with you, so I really thank you. I know you're busy, but I thank you for taking the time this morning and coming over here and talking to our audience about your services and about the mortgage process.
Sure, Jose. Thank you for having me. It was a lot of fun.
All right. Well, we'll see you guys next week on the next episode of the DMV Roundtable. Thank you for joining.